So, hello, Perennial Pride listeners. Thanks for joining me on this podcast. I think you're going to get a lot out of this one. I have a friend and colleague of mine, Chris Tormey. He's an advisor at Monaco Advisors, has an extensive experience in the investment and financial space. We'll learn a little bit more about that. And we'll cover a topic that I think is on a lot of people's minds today is where heck do I save money, right? What is savings anyway? So we're going to go through some the basic topics and hopefully share some insights on how you can think about this topic. But Chris, I want to welcome you to the Presiding Partner podcast. Thanks for joining me today.
Tom, thank you so very much for inviting me on. I'm a big fan. I've really loved the podcast that you've already put out, and I look forward to having a nice conversation with you today.
That's awesome. Yeah, and Chris went through we know each other from common circles of like-minded people. So always enjoy chatting with people who can bring in maybe a different perspective to a topic, and listeners, you're going to get some good stuff today. So Chris, tell us briefly a little bit about your background. I know I shared a little bit in the opening, but tell us a little bit of your background and kind of how it landed you to today in your current practice.
I appreciate that, Tom. Thank you. So I went to college and business school, always with a focus on investing and money. I graduated from the Darden School of Business at the University of Virginia and moved directly into what was then a brand new area called derivatives in the 1990s. And I spent several years in Chicago and London, and then back to New York, which is the area I grew up in. And I spent about 18 years in institutional derivative sales is what it was called, up until the market crash of 2008. And after that, I joined with some clients and worked at a couple of different hedge funds from 2009 through 2014. And it's then that I discovered really my true passion and what I've been doing now for the last 7 years, which is helping people to plan and to use the skills that I grew over my years of study, money, and working on Wall Street to help people to manage their cash flow, manage their money better, and prepare themselves for the future. So that's what I've been doing for about 7 years now. I'm at a company, a registered investment advisory firm called Monaco Advisors. We have offices in Fairfield, Connecticut and New Caney, Connecticut. And that's my story in a nutshell.
That's great. Yeah. And that's why it's interesting coming from that sort of background. You get to see different areas of finance, which we know finance is, people say personal finance is a pretty broad topic and a lot of different facets to it. So it'll be great to kind of hear as you go through this conversation, just your perspective coming from seeing it from, say, the institutional side as well. And some of the, maybe more sophisticated parts of the world people don't even know exist. Like our buddies.
I think personal financial planning is almost an occulted type product or service because I didn't know anything about it when I was on Wall Street or even working at the hedge fund. We had money management to attend to and we had trades to look at, but personal financial money management really has been a wonderful journey for me over the last 7 years too, for myself and my family.
Yeah, no, it's interesting. Yeah. And I think some people I've come across who maybe not well versed and they think their CPA is their financial advisor, right? So they're not trained on that either. They have their own expertise. So it is fascinating to kind of learn the personal finance space and the planning aspect of it. So obviously one core piece of anyone's financial plan starts with some basics, right? We call these, my mind from a football reference, blocking and tackling, right? You got to do some basics before you can start throwing these trick plays all around. And as it relates to your personal finance, I think one of the areas is saving money, right? And think about what's that, the richest man in Babylon. Save one coin of your 10, but right, basic stuff. But unfortunately, even I saw one stat recently, Chris, was that only like 30% of Americans feel like they can actually pay their bills and actually save consistently, right? That's crazy, right? To think about that. the majority of people can't save and forget about trying to invest and all that stuff. So, you know, from your lens, and maybe curious of what you think about this, like, why do you think it's so hard for people to save money, right, on a consistent basis?
Well, a couple of things that have happened since the time of Babylon. One is, we do have a fairly expensive and taxing set of authorities, whether it be our state, which is anywhere from 6 to 10% of your income, and then under the government itself, which ranges up to 37%, and they actually reset higher in a couple of years. Things don't change on the legislative front. That's one for sure. A second is I do think that the cost of things, even before this last 2 years, continues to escalate higher. So to maintain lifestyle, you've got to actually have more and more money, which comes out of income for people working and comes out of assets for people who are beyond their working years. So those are two areas. I think also there's so much available. There's so much on the airwaves and social media and the internet itself that the temptations of spending today and foregoing tomorrow are so high. It's a tough process. Easier said than done, as they say.
Yeah, I would agree. And I would add to the fact that, and I'm sure, Chris, in your world, you hear this on occasion too. I mean, even though maybe the time of this recording, the interest rates are going up a little bit, right? You're basically earning nothing by storing money and saving money. Right. So there's a lot less incentive to kind of just let it sit idle, even if you're able to save.
Well, in fact, I mean, this year, of course, investing the money has become a negative, a large negative for so many people. So savings is supposed to be that area that's the worst performer. At least that's the way we've been trained the last dozen years or so. But this year, savings is the number one for the moment, at least. So that's where its value lies. That's really why we have savings. The way I look at it is investing is giving up control of your money, of your cash to someone else or something else. Talk about real estate, things like that, in exchange for some perception that you're going to gain from that. There's value there that's going to be created over time, or that's not really showing itself that we believe is there. Whereas saving is withholding that money for yourself in wait for those investments or for spending. And this year, I think people with large amounts of savings can use some of that for spending, depending on their circumstances. It's a big difference between the two. And yeah, worth talking about. I'm looking forward to the conversation.
Yeah, always reminded, whether you're a fan or not, like Richard Kiyosaki's always a savers are for losers type of thing. And because I think, dude, I'm more of the ilk of, yeah, you need to save money and then figure out what you're investing in, right? And having some knowledge of where you're investing in. But saving in itself, I think, is still a good, consistent sort of habit people to deal with, should have for all facets of life, for all points of their lives. So let's maybe start there. I mean, I think it's important to think about when you're, because I know, Chris, you have clients that are young or even go maybe towards a retirement, span the sort of the demographic spectrum. But, maybe let's talk about like saving sort of through sort of aspects in your life, right? And the importance of it, what it helps you do, et cetera, and how you can maybe think about it.
Sure, absolutely. So cash flow during one's career, the way I look at it, the way we look at it at Monaco, is mainly derived from income. So there's something that you do with your energy, with your mind, with your body, that someone, whether it be customers or clients, if you're an entrepreneur, or the company you work for, if you're working for a company, will pay you. So income drives all the other cash flows during your career. Now, the other cash flows, we talked about taxes for people on the W-2, that really gets subtracted before they even see the money. But then there's lifestyle expenses, which is probably the next biggest one, insurance premiums, debt service. Debt service is an important one, mortgages, student loans, things like that. Basically, you need savings in case either your income is disrupted or something happens along the lines of the subtractors, taxes, lifestyle expenses, which could include obligations you have to owe as family members, insurance premiums, or debt service. You have a floating rate piece of debt, what have you. So savings come in almost like a capacitor or something that enters into the equation to serve when needed to balance the budget, to balance the monthly checkbook. And we like 9 months, sometimes even to a year, depending on what one does for a living and what one's cash flow structure looks like, held in reserve in savings to be ready for things that might occur in life. Because that's one thing we all have in common. We don't know what the future will bring.
Yeah, I think that's a smart move. But to your point, there's, depending on people's situations, their maybe security within their jobs, whatever the case may be, it could fluctuate. But, even if you have an amount to cover, like you were saying, things that maybe you were not expecting to happen, we fill some gaps. But we have a common sort of colleague in our lives, Kim Butler's, he always talks about opportunity funds, right? So you have money that's kind of unreserved to fill gaps, but what if you had extra money around to take advantage of opportunities that may come your way that you didn't see coming either? So what's your thoughts on that?
Absolutely. Absolutely. In fact, I put that in the same similar category to once you've finished your career and you're no longer earning an income from the things you do, you've got to be in a position to be earning that cash flow from the assets you've accumulated through the course of your life. And so if in your retirement years, if the years you've chosen to, or because of other circumstances, you're unable to work, a big drop in the value of assets, savings get brought into the equation to service lifestyle to give those assets the opportunity to go back up again. But if you have enough savings, whether you're in your working years or your retirement years, that you can add in to assets, whether they've just come down or you've just been introduced to them in terms of, potential value creation looking forward, that's a great use for savings as well. So whether you're in the working years and you see something that looks like it could generate great cash flow, or it's priced in a place where you believe through research, through conversations with usually the people who are going to be the operators of that particular asset, there's a big amount of value that can come from it. Then you've got your cash to be put towards those productive uses. And that tends to happen when markets are down, when liquidity is tight, when most people who haven't done the preparation, whether they want to or not, just don't have the money to. I remember in 2001, 2002, Apple Computer got down to single digit prices. Why didn't everybody buy it there? Well, everybody didn't buy it there because nobody had any money. That's why it was in prices. So that's just an example of a name that everybody knows. A lot of times there's opportunities and things around your area or areas in which you're particularly interested in or know people that are very good at what they do and are able to offer you those opportunities.
Yeah, no. And then it's difficult, right? Obviously when you're in, say a very difficult time and, it maybe is difficult to think about kind of going the other direction, zigging while everyone's zagging type of thing. And I think most people would argue, yeah, that's probably the time people make the most money, right? When you have people going one third is going one way, maybe going the other way might be advantageous, but you have to have the resources available. And I heard the other day, someone would say, hey, may not feel like all the money in the bank or wherever you're holding and storing cash is productive, but it's a potential call option to invest when time is right. And you might be the only one who has that call option available.
Absolutely.
Well, others are stuffed or having to sell assets.
Yeah. So once establishing that savings are valuable, where do you keep them? That's the big question that I was just speaking this morning to someone who was celebrating a 2% deposit rate that she found at a new savings account that she's opened up. So there's one place, banks. Banks are where most people go in their mind when they think about savings. But traditionally, savings were held at home. Oftentimes people would keep their savings on hand because in the past, there was, now we span decades ago, banks sometimes weren't all that safe when the trouble happened. So people would keep their cash at home. But there are a few things that really don't work very well from that standpoint. One is the hazards that might occur at the home, fire or theft or water damage or what have you, could ruin your cash that you store at home. The second thing, which is a problem for savings in general in many locations, is the buying power starts to disappear in the modern economy that we have here. So, if you saved $1,000 15 years ago, and you bring it out now, it's not worth nearly what it was then. So those are a couple of reasons why people really aren't saving cash at the house anymore. The bank account is really the spot that most typical, I think is the best way to say, is that people keep their money. And you and I have talked before this interview about, what actually happens behind the scenes at a bank account, because I've been fascinated by that, given that I've been working in and around the banking system for so many years. So I don't know if we're going to hop into that now, but it's an interesting topic to kind of have a chat about.
No, I think it is. I mean, I think to your point, like you said first, when someone gets a paycheck, a lot of folks in this listeners here, paychecks of money coming in, the IRS takes their cut, and then typically the rest goes into a bank.
Yep.
So it's important to know what happens there and whether it's secure or not, or how they're utilizing it.
Well, traditionally, and you'll see, I mean, there's a lot of restaurants now in New York that they used to be banks, and they had those giant vaults that they'll use as a tasting room or a party room or what have you. So banks originally had giant, very thick vaults to keep that money safe from hazards, safe from theft. And you felt good when you went in there to deposit it, that the bank was going to take care of it. And back then, prior to the 1930s or so, for everyone, cash was gold before the Federal Reserve came out in 1913. And then fully the whole world in 1971 went into a government or central bank money standards. So that's why the vault was there as well, to keep the gold protected. But what really happens in a bank, and I think people have a feel for this more so now since 2008, although that was a long time ago now, is that as soon as you make your deposit in the bank, they turn around and look for ways to make money with your deposits. So banking is the foundational component to a bank is the deposits. Once the capital is amassed by the people who want to open a new bank, and they're putting their equity into it and their career into it, if they decide to open a bank, the first piece they need, the fundamental building block of a bank, is the depositor.
Mm-hmm.
But once they get that deposit, it's really about lending the money out. And how many dollars they can lend out for every dollar deposited in varies. There was a standard for many years that it's 10% deposit base or cash held in that vault for every dollar deposited. So the other 90% goes out in loans. And these loans can be business loans that last a few months, or all the way out to 30-year mortgages at a fixed rate. And the nature of a bank is really these assets are not very liquid at all. They tend to be loans made to individuals or small companies who use their local banking relationships to get the money they need to do what the things they need to do. And so you as the depositor are contributing to, that that money that the bank is in turn making, the profits that they're making from those loans. And just to give you an idea, just to use one as an example, JP Morgan, Jamie Dimon took home about $90 million in 2021 for running JP Morgan, one of the biggest banks out there. And I believe they paid their employees, management and employees, billions of dollars to make those loans. So there's a lot of money in banking, a ton of money in banking. And I think 12 billion was paid out to equity holders. So those who decide to make an investment in JP Morgan to help to be part of that ownership structure. About 11 or 12 billion was paid out in dividends to the shareholders. But the poor little depositor doesn't get anything. And that's because the depositor is given the assurance that if the money's there, because again, the reason you have it there is for savings, if the money's needed, rather, the money's there. But in reality, when you get through the bank front door, you see that there's a lot of motion going on, a lot of motion making a lot of profits. They're very, very profit heavy institutions. So it might bring the question, are these really savings that I have in deposits?
Well, I guess that's the thing. I mean, from a liquidity perspective, like the RDS, that gives me that. But if it's meant to say, hey, how do I ensure that I can have money that's going to at least outpace and grow, well, I would argue that maybe that isn't really all that productive. But, and this is again where we've been accustomed to, this is where it has to reside. Yeah, I guess that's the thing. We've almost gotten used to the fact that it is not all that productive, at least in the world of low interest rates and low interest rate environments, that it's just what we have to deal with.
Yeah, and I don't know if you know the things that happened in the mid-teens, just less than 10 years ago, in Cyprus and Turkey, where depositors lost large percentages of the money they had deposited in these banks. It's happened in Sweden as well in 2008, 2009. So these are called bail-ins, where the depositor has to come in and basically, through taking a big haircut just meaning less than what they deposited in on their deposits, because of the losses that these loans were causing, again, behind the front door in the workings of the bank. So there were runs on the banks, by the thousands back in the 1930s. And in this country, in the United States. And that was a big reason why the Federal Deposit Insurance Corporation was formed, the FDIC, which protects 250,000 each of our bank accounts for liquidity on a dollar for dollar basis. But just to, again, I don't want to cause a run on the banks today, but the FDIC has about 35 or 40 billion in surplus to make up for losses at certain banks that are so severe that there's an insolvency, that they have less money than they owe the depositors. And you've got about 10 trillion in the banking system.
Yeah.
So you got 35 billion of insurance covering 10 trillion of deposits. And to stave off the risk of a run in the bank back in 2020, the government upped the FDIC guarantee to infinity, above the $250,000 limit. But nothing was added to the FDIC's actual cash surplus to serve that. The FDIC is sort of a government-sponsored insurance company. So it's really kind of interesting that we feel so comfortable, because for so many years it's done well. But if you look across the globe, and if you also across time, and also this trade-off of what's going on, we think that we've kept control of our money for ourselves, but in effect, a bank wouldn't be able to operate if it really just kept everything in the vaults. Because if you think about it, back when money was truly kept in the vaults, the depositors had to pay the bank for that, because you needed to hire guards, you needed to keep the money temperature controlled, or whatever else that had to be done. You needed to have the real estate surrounding the vaults So there was a pay-in for depositors, and that was really the only way the banks made any money. They would have to get agreements from other types of investors for anything longer than a deposit base, 3-month or 6-month or 5-year or longer dated loans. But that mismatch that seems a little unsettling when you really look at it is really the way a bank operates today, where the depositors feel like they have access to their money on demand immediately. But in fact, 90% or more of that money is committed long-term to very small and somewhat, lacking in liquidity type businesses. The mortgage market has a lot of trading going on, but for a lot of different things, the banks are lending out to people who, basically pay back on the money they make over the course of a few weeks or the course of a month. And that's the way the banking system works.
So we've kind of accepted I think more people today are starting to recognize that, especially with inflation the way it is, that, this is not a good deal on my end. Like I got to keep my money here, earn little to nothing. Yes, I have liquidity, but, and if you actually looked at it the way you described, is maybe as not as safe as they may have assumed. So what are other ways to store money that is liquid and can actually be more productive?
Well, there's one that I know that you and I are a big fan of. And the way I look at it is, imagine a situation where you can be the shareholder and also the depositor to a financial institution, and therefore get the surplus that your deposit is helping to generate from that institution's productivity, from their endeavors into the economy to make money off of your money. And one of those places, the one that I like an awful lot, and I know you do as well, is a mutual insurance company in a chassis of a whole life, a properly positioned, a properly constructed whole life policy. So looking at the two financial institutions for a moment, in comparison, the premium payer needs protection, typically death protection for his family, his or her family, is the only way an insurance company, a life insurance company, can exist. So without premium payers, there's no life insurance company, just like without depositors, there's no bank. And the first line of value, of course, is to have that money pooled and available to the surviving spouses and children and loved ones and so forth, when something tragic happens, when there's a death or a deep, deep disability occurs. But the way these institutions have set themselves up, and many have been in business for 150, 160, 170 years, so pre-Civil War, is basically they turn around and take your money and invest it in a set of usually much larger, more amassed capital sort of endeavors, like large purchases of real estate, corporate bonds, entire companies. A lot of times, since they know the insurance market so well, they'll buy entire insurance companies, sometimes even financial institutions. Oppenheimer Funds was a mutual fund company that was owned for almost 20 years by Mass Mutual Life Insurance Company. So they'll turn around and they'll buy these assets with the money that they bring in, pay their management, just like Jamie Dimon's paid as CEO of JP Morgan. There are people who, run these institutions extremely well, are amazingly talented people. But then after that, there are no shareholders who's put equity investment into it. The premium payer is who gets the surplus of the profitability of the mutual insurance company each and every year. And so an announcement's made every year, and certain premium payers, not for your term life insurance, not for your temporary life insurance, but for those people who are funding the portfolio, which is really able to go out there and make those investments, you become the shareholder and the depositors to use the banking term, of that money. And of course, the beneficiaries are paid before you are. So first management, then employees, then beneficiaries, and then finally, whenever's left over comes back to us. And over time, these are paid, anywhere from 3, 4, 5, 6% in the 1980s, even double digits, even 12, 13, 14%. Of course, that's a time when bank deposits were also in the high single digits, and all these assets travel with interest rates to some degree.
Yeah. And to that point, it's just, if you think about it and compare to, which I love the way you sort of presented that, is, money's flowing in through either deposits or premiums to help fund the business, right? Hopefully profitable business. And, life insurance companies, and they're held to a little different standard too around how much money they have to actually have on hand, right? In terms of capital that they need to have on hand to ensure the safety of the organization and all the insurance holders, right? They're well capitalized and investing in things that are relatively lower in risk in terms of where the money's placed, because they need to keep it safe, right? For the most part.
Yes, absolutely. I think, comparing again to the banks, the safety in terms of market moves could be similar, but the insurance companies have much, much more liquidity in the assets they own. They're able to sell the assets more easily on the open market than a bank portfolio of loans, which just are really tough to value. I mean, you've got local hardware stores and individuals and so forth and so on. Credit cards, where now the return is high enough perhaps in the credit cards to compensate for the lack of liquidity. But in many of these loans, there's not as much interest. And then, by the way, in downturns, the credit card payments might actually slow down or stop, leaving them with that kind of hole that they don't know really what to do with. And there are entire companies that spend their time looking for credit card portfolios that they'll buy from banks at, believe it or not, Tom, 2 or 3 or 4 cents on the dollar. So that's how much of a discount they write. And that's just not the business for the big mutual insurance companies. They tend to be want to be the head of the boardroom table for large companies as primary funders of those companies, which is a nice place to quadruple, in my opinion.
Yeah. And, we won't have time to go into it deeply. We have other episodes that touch on this to some degree, but you mentioned earlier in this conversation that most people's income, they get, the IRS would take their cut up front and then get to the bank. Well, in this environment, the bank environment, any interest you actually earn is subject to tax. So you got to take a little haircut there. But in the world of, the life insurance world, there are certain rules around it that actually you could defer and potentially never pay tax on it, right? Can you talk a little bit about that?
Yeah, certainly. So the insurance industry predates the IRS. So the IRS had to sort of conform itself to the insurance industry. And the IRS has never wanted to get involved in the payout of the death benefit to a surviving spouse. I mean, you've got a very, very tragic situation. That's really just not where they want to involve themselves. So as a policy owner, your premiums are eventually going to pay your loved ones in your death. And so from that standpoint, all proceeds from someone passing away are tax-free and paid to the surviving loved ones as put forward in the beneficiary designations. So because of that, as the money grows over time, we didn't really talk much about this, but what happens is you have your death benefit, which is a very large number for the amount of premium you're putting in. But then you have a cash value that grows, as I said earlier. It takes a little while to get going because there's so much to basically invest in. You're kind of partnering with a large financial institution, which is giving you that, that ownership of leftover surplus every year. You don't have to invest in it like a stock investor might have to just lump over thousands of dollars to earn that dividend. You're just paying in premiums. So the early years, the premiums don't fully get the cash value that you put in. But really, by the time you get into a handful of years, the new premium you put in immediately has the cash value that you put in there, and then eventually grows in that, as I said before, 2, 3, 4, 5, even in this environment, even 5.5%. And it grows tax-free. There is no 1099 form sent to you. Its growth is actually on a slope to get up there with the death benefits in sort of the actuarial year that the insurance company, the actuaries feel someone will be passing away. And of course, it jumps right up to the death benefit when somebody passes. So that's an immediate change in value from the cash value to the death benefit. But 99 typically is the year that your cash value and your death benefit are the same number. And so at that point in time, everything you've put in has grown tremendously. You've probably only put in a quarter or a fifth of that amount that is now worth in cash to you, should you be able to or want to use it at age 99. And I hope we all are able to and want to. But of course, if you pass away that year, it's also the death benefit. And it does continue growing after you're 99. You just have the two on the identical path, the identical line from that foot forward. So it's a tax, if done right, it's a tax-free growth vehicle for yourself. And that's a good point, Tom. Deposits are taxed. So not only are dividends taxed at a bank for the investment you made to be an owner, a share owner of that company, but also deposits are taxed. So if you get a 2% deposit rate, roughly half gets taken in a year by your federal and state treasuries.
Yeah. And we always have to think of it this way. It's a simple concept to say, and you get to enjoy what you get to keep out of all your money. I don't care about a rate of return. If I'm looking at apples here, I need what I'm going to be able to spend. And, and thinking about this too is the same thing that I run across people who are their term insurance policies are just about to expire, and they are doing what most will do is outlive it. So, they're actually thinking about how I get to something so they actually can pass some wealth to the next generation, as opposed to, in their minds, wasting that money. Now, I don't think of it as a waste of money, but, in their eyes, they said money is no longer in my family's life. And so we're able to do something you're suggesting, and you may be able to defray some of the costs of term insurance as well. On top of
absolutely.
That's right. Yeah, and that goes into more money for you to save and invest and do all those great things. So, that's really helpful, and it's a powerful tool just to kind of think. But when you line them up between the bank and life insurance, and you think about the core aspects of them, they're all collecting money and using it in a productive way. Just
that's an interesting. It should basically make very clear about that is with the bank. I'm old enough to remember the first ATMs being installed. So it was this magical thing where now you didn't even have to go into the bank and wait online and then fill things out. And then they look at you 2-3 times and finally lay out the money for you. You could just put your card in and out comes the money. How more liquid could your savings be than that? And insurance companies, I think most people, I'd say 90% or 95% of people think, once the premium check is written, that money is just gone until the inevitable, but the catastrophic happens. But over the last 5 to 10 years, because of the advent of the internet, you can have websites set up for your policy where you can move money within a day from your insurance savings account, your cash value, into your preferred checking account, the same place that your weekly or biweekly paycheck comes from. Those two. So that side of the equation, it's like you're not writing it away for some future unknown moment. Basically, it's as close to you as your bank is. If you want to think about your bank as an internet-based institution as well these days, which it's happening for me more and more. I don't go to the brick and mortar bank anymore. I just do everything as they made it so easy to do online. Identical setup, really, really nicely done by the mutual insurance companies to allow you access to that cash. But you always want to get that cash back in once your investment's done well, or once your need is passed and your income's coming back, because that helps to keep the growth continues while you have it out. But it does come out typically through a loan to the insurance company, which is another asset that the insurance company has. Policy loans, that's about 3 or 4 or 5% of their portfolio. And that loan is somewhere around the same amount that you're making on your cash value growth. It's not by contract, but it sits around that same low single digit type levels, but easily accessed, which is just a nice thing, a comforting thing for my clients when I show them how it all works.
Yeah, and it's just like anything else, getting staying open-minded and kind of and learning about it to understand it for what it is. And I think there's a lot of wisdom you shared today. I really appreciate your time, Chris. And and I'm going to cut this down here. I want to definitely maybe another time talk about the use of those dollars, because this is just a savings tool, and it obviously provides a lot of benefits like protection and against life, death, and disability. But frankly, a lot of ways I think of it as control, and having the ability to control what happens in our lives, our family lives, and having more of our resources do more for us. Right. And this really why we have this podcast, to share these ideas and bring experts that can shed you a different way of doing things that might be more advantageous or provide more benefit to you. So, Chris, I really appreciate your time and your expertise and insights you share with my listeners here, and I appreciate it.
I appreciate your time. Thanks very much. It's been a pleasure talking to you, and let's hope again real soon.
Absolutely. Thank you for being with us here today on the Presiding Pride podcast. It's an honor to be a small part of your journey to financial freedom. If you gained new insight on today's episode, please follow us on your favorite podcast app, such as Apple or Spotify, and follow us on our YouTube and Facebook pages. Also, we always love feedback on helping to improve what we're doing here. So please provide in comments and questions so we can make this podcast even more helpful for you.